Welcome back to the AlgoBot channel, where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm AlgoBot, and today we're studying a strategy called compression ledge continuation. It's a trend-following continuation approach built around a slow-moving average baseline and the average true range. Over the next few minutes, you'll learn how this strategy reads an existing trend, how it spots a tight pause it calls a ledge, and how it looks to join the next step of that trend. Everything here is educational only, so let's walk through the ideas together. The core idea behind compression ledge continuation is that trends rarely travel in a straight line. Instead, they tend to climb something like a staircase. Price drives in one direction, then pauses on a short shelf where it coils and settles, and then it drives again to the next step. This strategy is designed to study those steps and to participate only in the direction the market is already moving. It is not a range breakout system, and it is not a mean reversion fade. It always aligns with the prevailing drift. The indicator engine is deliberately simple. A slow, simple moving average acts as the trend baseline, and the average true range, or ATR, measures how much the market typically moves so that every threshold can be expressed in volatility units rather than fixed points. That makes the same settings behave consistently across different symbols and different levels of activity. Three gates must all agree before the strategy signals a trade. The first is the trend gate, which requires the slow-moving average to be sloping by at least a minimum amount, measured in ATR units, with price sitting on the correct side of it. The second is the ledge gate, which requires the most recent closed bars to form a genuinely tight shelf that rests around the baseline, rather than a wide, choppy churn. The third is ignition, which requires a bar to actually close beyond that shelf with a decisive body, while filtering out entries that are already stretched too far. This kind of approach may interest traders who like structured, rules-based continuation setups and who prefer a clearly defined, structurally tight stop. As always, trading involves risk, and losses are a normal part of any strategy. This overview is for education only, not financial advice. Let's walk through the exact logic, step by step. On every completed bar, the strategy first measures the slow, simple moving average now and the same average a number of bars earlier, set by the slope bar's input. The difference between them is divided by ATR to give a slope reading in volatility units. For a long, that slope must be positive and at least the MinSlopeAtr value, and price must be above the average. For a short, the slope must be negative by the same amount, with price below the average. This is the trend gate, and it keeps the strategy from fighting the dominant direction. Next comes the ledge gate. The strategy scans the shelf of bars that come just before the current bar, spanning the ledge bar's window. It records the highest high and the lowest low across that window. If the total range of that shelf is wider than LedgeMaxAtr times ATR, the shelf is treated as a churn rather than a genuine pause, and no trade is considered. The shelf must also rest around the baseline. For a long, the shelf sits on top of the rising average, dipping no more than the ShelfDipAtr tolerance below it. For a short, it mirrors that beneath a falling average. A tight shelf gives a tight, well-defined stop, and that is the engine of low drawdown here. Then comes ignition. For a long, the current bar must close above the shelf high, and it must be a bullish bar, closing above its open. That is acceptance beyond the shelf, not just a brief wick. A final no-chase filter checks that the close is not already extended more than MaxChaseAtr beyond the shelf, because chasing an already stretched break is a common source of continuation drawdown. The short side is the exact mirror, requiring a bearish close below the shelf low. When all conditions align, the strategy signals an entry. For a long, the stop is placed just below the shelf low, offset by a small ATR buffer, and the initial risk is the distance from entry to that stop. The take profit is set at the risk-reward multiple of that risk, defaulting to 1.6. The short side places its stop just above the shelf high. Finally, once price has traveled break-even R of the initial risk in the trade's favor, the stop is pulled up to the entry price, reducing the remaining exposure on that position. Let's read the code the way you would in MetaTrader. At the top are the inputs. Lot sets the trade size. SlowSma and slope bars define the baseline and how far back we measure its slope, while MinSlopeAtr sets how steep that slope must be in ATR units. Ledge bars and LedgeMaxAtr describe the shelf width and how tight it must be, and ShelfDipAtr controls how far the shelf may sit from the baseline. MaxChaseAtr is the no-chase filter. Risk-reward sets the target as a multiple of risk. Break-even R controls when the stop moves to entry, and BufferAtr is the small cushion past the shelf. Now look at the long block. For Boolean checks must all be true together. Uptrend confirms the slope, and that price is above the average. SlowSma confirms the shelf rests on the rising baseline. Ignite up confirms a bullish close above the shelf high, and no chase up confirms the close is not overextended. When they align, the code reads the ask price, sets the stop just below the shelf low, computes the take profit as risk reward times the risk, and calls trade.buy. The short block is the exact mirror. Downtrend, SlowSma, Ignite DN, and no chase DN confirm a falling baseline, a shelf beneath it, a decisive bearish close below the shelf low, and no overextension. The stop goes just above the shelf high, the target sits the same or multiple below entry, and trade.sell is called. Let's walk through this illustration candle by candle, starting on the left. The blue line running beneath the candles is the slow, simple, moving average, our trend baseline. In the first few candles, notice that price is stepping higher and the baseline is sloping upward beneath it. That rising slope, measured in ATR units, satisfies the trend gate for a long, and price is comfortably above the line. So the market is in an established upward drift, exactly the condition this strategy wants before it looks for a step. Now watch the next three candles. Price stops advancing and settles into a tight cluster. The bars overlap, their ranges are small, and the whole shelf sits just on top of the rising baseline. This is the ledge, or compression shelf. The strategy checks that the total span of these bars is no wider than the LedgeMaxAtr tolerance. So this is treated as a genuine pause where price coils and refuels, not a wide, choppy churn. The shelf resting right around the baseline confirms this is a with-trend pullback step. Then comes the break bar. A bullish candle pushes up and closes clearly above the shelf high, with a decisive body from open to close. That accepted close is the ignition of the next step, and it is where the buy entry marker appears. Importantly, the close is not stretched far beyond the shelf, so the no-chase filter is satisfied and the strategy is not chasing an already extended move. The stop-loss marker sits just below the shelf low, offset by a small ATR buffer, which gives a structurally tight risk because the shelf itself was tight. The take profit is set at a fixed reward-to-risk multiple, 1.6 by default, above the entry. From there, price runs upward over the following candles. As it travels the break-even R distance of the initial risk, the strategy pulls the stop up to the entry price, trimming the exposure. Price then reaches the take profit target marker, and the long step is complete. Now the character of the market changes. Price rolls over, the baseline flattens and begins to slope downward, and price drops below the line. That flips the trend gate to the short side, signaling an established downward drift. Watch the next couple of candles form another tight shelf, this time resting just beneath the falling baseline. Again, the strategy confirms the shelf is compressed enough to qualify as a genuine pause. Then a bearish candle pushes down and closes below the shelf low with a decisive body. That is the mirror image ignition, and the sell entry marker appears there. The no-chase filter confirms the close is not already overextended below the shelf. The stop-loss marker is placed just above the shelf high, once more a tight structural stop. The take profit sits the same reward-to-risk multiple below the entry. Price then steps lower over the final candles. The break-even logic protects the position along the way, and price reaches the downside take-profit target. That completes the short step. In both cases, the strategy only ever joined the direction the trend was already traveling, and always after a tight shelf gave it a well-defined place to hide the stop. This is an educational illustration of the logic, not a prediction of results. So that's compression ledge continuation. We saw how it reads an existing trend with a sloping moving average baseline measured in ATR units, how it identifies a tight compression shelf resting around that baseline, and how it waits for a decisive, accepted close beyond the shelf before signaling an entry, while a no-chase filter avoids stretched breaks. We also covered the structurally tight stop past the opposite shelf edge, the fixed reward-to-risk target, and the move to break even once the trade is far enough ahead. Remember, this video is educational content only and not financial advice. Trading carries real risk, and losses do happen. If you found this helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with the strategy you'd like next. Learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.